something has changed in the American housing market. And it is not the thing you think it has changed. It is not mortgage rates. It is not inventory. It is not the first-time buyer who still cannot afford to enter the market. Those stories are real, but they are not the story of 2026. The story of 2026 is this: the largest buyers American real estate has ever seen. The institutional investors, the Wall Street landlords, the private equity firms that collectively purchased hundreds of thousands of homes during the pandemic boom and declared their intention to hold them forever, are selling. Quietly at first, and now not so quietly. Research from housing data and analytics firm Parcl Labs, published in March 2026, found something that should alarm every homeowner in every market these investors touched. In every single major metropolitan housing market in America, not some, not most, but every single one, investors now make up a larger share of for-sale listings than they do of the total housing stock they own. They are listing to sell at rates that dramatically exceed their share of ownership. The money that was supposed to hold these markets up from the demand side is now flooding the supply side. And in some cities, the exit velocity has reached a level that Parcl Labs describes as deeply motivated selling. Investors willing to cut prices, willing to reduce asking prices every 3 weeks, willing to take losses just to get out. Jason Lewis, co-founder of Parcl Labs, told CNBC. It's a volatile housing market, and folks are trying to take risk off the table. Rents are not holding up relative to what investors can get if they sell. So it's better risk-adjusted returns to just get that cash and see how things pan out. Get that cash. That is what this video is about. Where the cash is being pulled out, what it is doing to prices, and what every person who owns property in these 10 cities needs to understand before the exit accelerates further. Orlando, Florida. Orlando ranked as the metro with the single largest year-over-year decline in investor home purchases of any major city in the United States in Q4 2025. Investor purchases in Orlando fell 16% year-over-year, according to Redfin's Q4 2025 investor report published in February 2026. That was the biggest drop of 38 major metros analyzed nationally, the largest retreat of investor buying activity of any American city. And if you look at the full trajectory, the numbers tell a story of sustained, accelerating retreat. In Q1 2025, Orlando investor purchases were down 13% year-over-year. In Q2 2025, they were down 18%. In Q3 2025, they were down again. Every single quarter of 2025, Orlando investors bought fewer homes than the year before, in an unbroken chain of quarterly declines. Why? Because in Orlando, the buy-to-rent math has inverted. During the pandemic era, investors bought Orlando homes assuming perpetual rent growth, low insurance costs, and appreciating asset values. All three assumptions proved wrong simultaneously. Florida home prices are falling. According to Zillow, the median home value for the state of Florida has dropped 4% over the past year as of November 2025. Inventory is at record highs. Florida has more active listings than any other state in the nation, over 167,000 homes, representing approximately 15% of all active listings in the United States. Insurance costs have increased 60% since 2019 according to Reuters data. HOA fees across Florida condo buildings are rising sharply following new state legislation requiring reserve fund compliance. And the rental income that was supposed to make all of this worthwhile. Rents in Orlando have been declining from their pandemic peaks. The income investors counted on to service their carrying costs, pay their insurance, and justify their purchase prices is not there. The investors are not selling because Orlando is recovering. They are selling because the numbers they used to buy no longer work, and they have decided to exit before those numbers get worse. CI-9 Fort Lauderdale, Florida. Fort Lauderdale's investor retreat is the most specific and documented of any Florida market, because it involves a segment of the market where investor losses are now measurable and named. In Q4 2025, investor purchases in Fort Lauderdale fell 15% year-over-year, the second largest investor purchase decline of any major metro in the United States, according to Redfin's Q4 2025 report. In Q2 2025, Fort Lauderdale had the second largest investor purchase decline nationally at -15%. In Q1 2025, investor purchases were down 12% every quarter. Every analysis. Fort Lauderdale appears at or near the top of every list of cities where investors are retreating. Fort Lauderdale Redfin premier agent John Tomlinson told Redfin directly, "The condo market is the slowest I've seen in at least a decade. buyers are wary of putting offers on condos, and many are canceling contracts after they've made offers because costs have increased so much, and they're nervous that they'll continue rising in the future. The slowest in at least a decade. And Tomlinson is talking about the market where investors are now trying to sell the condos they bought during that pandemic-era buying frenzy. Homes that are now spending, on average, 114 days to go under contract, according to Redfin's November 2025 national housing data. 114 days of carrying costs, HOA fees, insurance payments, and mortgage servicing, while the market decides whether to produce a buyer at all. Broward County inventory, the county that contains Fort Lauderdale, surged approximately 80% year-over-year at the peak of Florida's inventory surge, according to Realtor.com data. In a market with 80% more homes for sale and a buyer pool that is actively skeptical of taking on the ongoing cost burden of Florida condo ownership, the investor who needs to exit is competing against hundreds of identically motivated sellers. This is what a market trap looks like. Everyone wants to sell. No one needs to buy right now. The exit price is a function of who breaks first. CITY8 Nashville, Tennessee. Nashville was supposed to be the Sun Belt market that survived the correction. The population growth was real. The job market was strong. The country music economy kept tourism high and the city's brand intact. But the investor data from 2025 is telling a story Nashville boosters do not want to tell. In Q4 2025, investor purchases in Nashville fell 9% year-over-year, according to Redfin's Q4 2025 investor analysis. Nashville joined Orlando and Fort Lauderdale and Las Vegas as one of the top 5 markets nationally for investor purchase decline. And in Q2 2025, the quarterly analysis placed Nashville in the top 5 markets for investor buying decline nationally, at down 9% year-over-year. The mechanism in Nashville is different from Florida, but the end result is the same. Nashville experienced massive new construction during the pandemic boom years. Developers built aggressively into what appeared to be permanently elevated demand. Builders pulled permits for tens of thousands of units. By 2025, that construction pipeline was hitting the market simultaneously with investors who wanted to exit, doubling the supply pressure at the exact moment buyer demand was weakening due to high mortgage rates. Redfin's November 2025 monthly housing data showed Nashville median days on market increasing by 17 days year-over-year, one of the 5 largest increases in the country. Every day, a Nashville investor property sits on the market costs money. The holding costs of Nashville real estate during extended selling periods are not offset by rents that have softened as new apartment supply has flooded the market. The investors who paid peak prices in 2021 and 2022 in Nashville's most overbuilt submarkets are now selling into a market where the buyers are waiting and the supply is mounting. The music in Nashville is still playing. But for the investors who bought at the peak, the numbers have stopped working. CITY 57 Jacksonville, Florida. Jacksonville presents a specific case study in the gap between local real estate marketing and the harder numbers from national data systems. Local Jacksonville agents will tell you the market is resilient, that buyers are stepping up, that inventory is leveling off, and there is some truth to each of those claims in certain price ranges in certain submarkets. But here is what the national data says about Jacksonville. Redfin's 2025 year in review named Jacksonville as having the single largest year-over-year price decline of any major American metro. Prices fell 3.1% year-over-year, the worst price performance of any city in Redfin's national analysis of the 50 largest metros. In Redfin's November 2025 data, Jacksonville led all metros with home prices down 5.6% year-over-year. In October, Jacksonville was down 4% year-over-year, again leading the nation in price decline velocity. For investors, the Jacksonville math has inverted in a way that is particularly severe. Investor purchases in Jacksonville fell 7% year-over-year in Q4 2025 and fell 16% in Q2 2025, among the worst quarterly investor purchase declines in the country in that period. According to Jacksonville's January 2026 MLS data, closed sales were down 7.6% year-over-year. Pending sales showed a decline of 24% on one comparison metric. Active inventory reached 835 homes with 6.1 months of supply, meaningfully above the 5-6-month balanced market threshold. Nearly 30% of all active listings had received price reductions, according to Realtor.com. The investors who bet on Jacksonville's growth story are now discovering that growth story cities, produce more new homes than the growth itself can absorb. When supply outpaces the migration driving that supply, price is correct. And in Jacksonville, the correction has been the sharpest in the country. Measured by Redfin's comprehensive national dataset. CITY Heinz Tampa, Florida. Tampa tells the story of what happens when a market gets hit with multiple simultaneous shocks. And the investors who bought into that market absorb the full combined impact. Shock number 1: home values. According to Zillow data reported by Tampa Bay Business Wire, in November 2025, 2% of homes in the Tampa metro are currently below their peak values, with an average decline of 12% from peak. 85% of homes in the market below peak. The average investor who bought Tampa real estate at any point from mid-2020 through the peak in 2022 is now holding an asset worth less than what they paid. Shock number 2: the condo collapse. Tampa condos and townhomes fell 12% in value during 2025 according to Florida Realtors data, more than 8 times the single-family price decline rate. Investor purchases of condos nationally have been sitting near decade lows for 2 consecutive years. In Tampa, where condo buildings face reserve fund compliance requirements from Florida's post-Surfside legislation, HOA fees have surged and insurance costs have compounded those increases. The investor math on Tampa condo ownership is deeply negative. Shock number 3: insurance. Florida homeowners have watched insurance premiums rise 60% since 2019. In Tampa Bay, specifically in the coastal Pinellas County communities hit by Hurricane Helene and Hurricane Milton in 2024, some properties are in areas where private insurance has become unavailable, and the carrying costs have become impossible to justify at current rent levels. According to Redfin's Q2 2025 investor report, Tampa investor purchases fell 13% year-over-year. In Q3 2025, the decline continued. And according to Parcl Labs' 2026 analysis, Tampa is one of the 4 markets nationally showing the highest listing skew, the deepest purchase-to-sale declines, and the most urgently priced inventory. Urgently priced. That is the analytical language for what Reventure Consulting said more directly. Investors are now liquidating properties and taking a 20% loss from what they bought it for 2 years ago. 20% losses on homes purchased 2 years ago. In Tampa, CITY 5 Houston, Texas. Houston has emerged as one of the 3 most aggressive investor exit markets in the country, and the data behind that designation is the most specific and alarming available in 2026. According to Parcl Labs research published in March 2026, Houston investors own approximately the same percentage of the city's housing stock as in most major cities, but they account for 10 times their ownership share in for-sale listings. For every dollar of Houston housing stock investors own, they are generating more than $2 worth of for-sale listing activity. They own proportionally. They are selling disproportionately. That 10x listing to ownership ratio places Houston among the 3 most investor-motivated exit markets in the country. The conditions driving that exit are visible in Houston's raw market data. According to Housing Wire's November 2025 analysis using HW data, Houston had 34,676 active homes on the market, the highest inventory of any major Texas metro. Weekly home absorption dropped 21.6% year-over-year. Days on market reached 91 days, the highest of any major Texas city and matching the statewide average. The price cut rate in Houston reached 39.7%, meaning nearly 4 in every 10 Houston active listings had already received a reduction from original asking price. The Texas Real Estate Research Center Q1 2025 report used language that should stop every Houston investor in their tracks. Price cuts in Q1 2025 accelerated compared to 2023 and 2024, reaching their highest since 2011, a period marked by widespread foreclosures. Houston's price cut rate is at the highest level since 2011, since the foreclosure era. That is not a coincidence. That is the market telling investors what the exit price needs to be. And the investors are listening. They are cutting prices, listing at twice their ownership share, and trying to recover whatever capital they can before Houston's correction deepens further. CITY 54 Philadelphia. Philadelphia should not be on this list. That is what makes it alarming. Philadelphia is not a Sunbelt boom-bust city. It is not a market that overheated on pandemic migration or remote work speculation. It is not a coastal luxury market. Philadelphia is a dense, older, affordable, by comparison northeastern city that attracted investors specifically because it did not fit the profile of an overheated market. And yet, According to Parcl Labs' March 2026 analysis, Philadelphia investors have a listing to ownership ratio of 236x, the second highest investor exit ratio of any major metro in the entire country, higher than Houston, higher than Tampa, higher than Atlanta, higher than every city on this list except Dallas. In Philadelphia, investors own a certain percentage of the housing stock. They are listing for sale at 2.36 times that percentage. The gap between what they own and what they are selling has widened to the second most extreme level in America. The report published in October 2025 by Reinvestment Fund and Rutgers Law School documented that corporate investors purchased roughly 1 in 4 small residential buildings in Philadelphia between 2017 and 2022, concentrating their holdings primarily in Black and Hispanic neighborhoods in Northwest and Southwest Philadelphia where prices were lowest. Brewerytown, Germantown, Juniata Park, King Sessing, Cobbs Creek, the neighborhoods where investors were most active from 2017 to 2022, are now the neighborhoods generating the most investor for sale listings. CNBC's reporting on the Parcl Labs data named Philadelphia directly alongside Dallas and Houston as one of the cities where investors are selling most aggressively. Rodney Willis, a longtime Cobbs Creek resident quoted by WHYY in October 2025, described what he was watching in real time. Just in the last 18 months, I've watched 8 properties go on sale on my block. That type of activity has the power to disrupt the community's fabric forever. 8 properties on a single block in 18 months. From investors who were supposed to be long-term landlords. Selling now. City number 3, Atlanta, Georgia. Atlanta is the city where institutional investor concentration reached its most extreme level in American history. And it is now the city where the exit velocity is producing some of the most alarming market signals in the country. According to research from John Burns, Research and Consulting published in July 2025, Atlanta has the largest share of single-family rental home stock owned by institutional investors, defined as those owning 100 or more properties, of any major American city, at 27.9% of the single-family rental market. That is 4 times the national average. In the zip codes most concentrated with institutional ownership, large investors own over 10% of all single-family homes outright, according to Parcl Labs data. 13.3% of all large institutional investors' entire national portfolios, their Atlanta holdings, their Dallas holdings, their Charlotte holdings, all of it, are concentrated in the Atlanta metro, more than double the second closest market. And now they are selling. According to Parcl Labs data reported by CNBC on March 4, 2026, last week, investors in Atlanta are now selling nearly 2 homes for every one they buy. Not a slight imbalance, nearly 2 to 1. Selling acceleration that began in late 2024 and has continued intensifying into 2026. The Georgia Association of Realtors, AFR, 2025 annual report, released on February 3, 2026 captured the consequences in raw market data. Days on market across Georgia rose to 56, up 21.7% year-over-year. New listings rose 7.8% while closed and pending sales declined. Active inventory climbed 13.1%, with months of supply reaching 3.9, a 14.7% increase year-over-year. And Parcl Labs documented the neighborhood-level cascade effect of the large institutional selling. In zip codes where large operators dominate, smaller investors managing 2 to 9 properties are also listing at elevated rates. In some Atlanta neighborhoods, small investors account for 1 in every 5 homes currently on the for-sale listing market. Panic at the top of the investor pyramid is spreading downward to the small landlords beneath them. Redfin's 2025 year in review data confirmed Atlanta's price trajectory. Prices fell 2.5% year-over-year by October 2025. The city that was supposed to be the permanent institutional investor anchor is now producing cascading for sale listings from every tier of the investor ecosystem. City number 2. Dallas, Texas. Dallas is the city where the Parcl Labs data produces a single number that should stop every real estate investor in the country cold. Dallas investors own 9.2% of the city's housing stock. They account for 22.8% of new for-sale listings. Own 9.2%. selling 22.8%. That is a listing-to-ownership ratio of 2.48 times, the highest investor exit ratio of any major American metro in the country. No city's investors are more disproportionately motivated to sell relative to their ownership stake. Dallas is the ground zero of the 2026 American investor exit. CNBC's reporting named Dallas, alongside Philadelphia and Houston, as one of the 3 cities where investors are selling most aggressively. Parcl Labs named Dallas, Atlanta, Houston, and Tampa as the 4 markets showing the highest listing skew, the deepest purchase-to-sale declines, and the most urgently priced inventory. The most urgently priced, that is the term. In Dallas, institutional investors are cutting prices to move product. Parcl Labs reported that First Key Homes, one of the largest institutional landlords in the country, is offering an average 10% off original list prices on its Dallas properties and is reducing prices approximately every 20 days. Every 3 weeks, another price cut until a buyer appears. The market data confirms why. According to the S&P Totality Case-Shiller Home Price Index published in February 2026, Dallas home prices fell 1.52% from December 2024 to December 2025, placing the metro among the weakest-performing markets of the 20 cities tracked nationally. The report noted that inflation outpaced home price appreciation beginning in June 2025, eroding real home values through the end of the year, reversing a decade-long trend of positive real returns. According to M&D Real Estate's comprehensive DFW 2025 market report, home values fell an average of 5% across Dallas-Fort Worth in 2025. In the Dallas-Plano-Irving area, the specific submarket at the epicenter of the institutional investor concentration, rapid inventory growth drove the steepest price declines in the metro. According to WFAA/Dallas Morning News, reporting on the Case-Shiller data, in the period from October 2024 to October 2025, nearly 87% of homes in the DFW metro lost value. Not depreciated from peak. Lost value in a single 12-month period. 87% of homes. The investors who own 9.2% of Dallas housing stock, and who are accounting for 22.8% of new for-sale listings, know exactly what that statistic means. They are not selling because Dallas has recovered. They are selling because they believe it has not, and they want to be out before the next 12 months produce the same result. City number 1, the national picture. We have given you 10 cities. We have given you specific percentages, specific analysts, specific transaction data. But the finding that sits above all of it, the finding that Parcl Labs published in March 2026 that should inform every housing market decision every American makes for the next several years, is this. In every major metropolitan housing market in the United States, investors are listing their homes for sale at a rate that exceeds their ownership share. Not in the distressed markets, not in the overbuilt ones, not in the hurricane-exposed ones. In every single major metropolitan area of this country, the ratio of investor for sale listings to investor ownership is greater than 1.0. The net position of institutional real estate investment in America has shifted from accumulation to distribution. Parcl Labs researchers stated it directly. Across 13 of the top 20 U.S. metros, investors are listing at more than 1.5 times their ownership share. Purchase activity has been declining since rates rose in 2022. The White House proposal targets a behavior the market has been pulling back on its own for years. Therefore, the policy may accelerate what's already in motion. The political theater around banning institutional investors from buying more homes is largely irrelevant to what is actually happening. They are already leaving. The legislation, if it passes, would ban behavior that the market has largely already stopped. What the legislation would not address is the selling. The 315 homes invitation homes sold in Q4 2025 while buying 0 existing homes, only newly built ones from builders. The tens of thousands of homes, First Key Homes, is pricing at 10% below original list and reducing every 3 weeks. The Atlanta market where investors are selling 2 homes for every one they buy. The Dallas investors who own 9.2% and are producing 22.8% of for-sale listings. When large-scale sellers enter a market and cannot find buyers at current prices, one of two things happens. They reduce prices until buyers appear, or they withdraw listings and wait. In the markets on this list, Dallas, Atlanta, Houston, Tampa, Jacksonville, Philadelphia, Nashville, Fort Lauderdale, Orlando. The most motivated sellers are reducing prices. First Key Homes is reducing prices. Parcl Labs is calling it urgent pricing. CNBC is calling it an exit. The effect on regular homeowners in these markets is not abstract. As Parcl Labs researchers wrote, the result of a significant exodus of investors could be to move down local home prices for all sellers, not just institutional ones. Not just for the institutional sellers, for every homeowner in every zip code where institutional portfolios are concentrated. For the person who bought a home in Atlanta's most investor-saturated neighborhoods in 2021. For the Dallas homeowner whose neighbor just had their price cut for the third time this month. For the Tampa family whose Zillow estimate has been dropping for 18 straight months. The investor exit is not a story about Wall Street. It is a story about what happens to the neighborhoods and cities that Wall Street chose, and is now choosing to leave. Before we close, the honest assessment, as always on this channel. The institutional investor exit from American housing is not a crash. Let us be precise about what the data shows and what it does not show. Home prices nationally are still higher than they were 5 years ago by significant margins in most markets. Redfin expects 2026 to be a year of gradual normalization. The total value of American residential real estate remains near record levels. Regular homeowners in desirable supply-constrained markets are not facing the conditions this video describes. But in the specific markets on this list, the pandemic darlings, the Sunbelt boom cities, the neighborhoods where institutional capital concentrated between 2020 and 2022, the data is telling a story that the marketing materials are not. When the largest holders of residential real estate in American history start selling faster than they buy, in every market simultaneously, with price cuts every 3 weeks, that is a signal. Not necessarily a signal of collapse, but a signal that the assumptions underlying the prices in those markets have changed. The investors know something. They are acting on it. The question every homeowner in Dallas, Atlanta, Houston, Tampa, Jacksonville, Philadelphia, Nashville, Fort Lauderdale, and Orlando now has to answer is whether they know it too. Thank you for watching this report from Discover the States. If this analysis is relevant to where you live or invest, leave a comment with your location and what you are seeing on the ground. Subscribe so you do not miss the data reports that follow.